just to illustrate that for the people who are looking, the purple line, which goes up and then down, that is the May open interest in number of ounces. And as was explained, there's open interest representing 134 or 135 million ounces at the moment. That's potentially, so if every single contract was called for delivery, that's potentially how much could be called for delivery. In practice, that number, as you see the line is trending down, that number is going to go down in the coming days. The blue line at the bottom, trending downwards, it shows the number of registered ounces of silver available at COMEX. It's currently 77 million ounces, a lot less than 135 million of open interest. So currently we have 77 million ounces available for delivery. It's called registered. There's also what's called eligible, which is not available for delivery, but it's actually parked at COMEX, but it could be owned by hedge funds, it could be owned by ETFs, it could be owned by third parties. But technically, some of those third parties might be able to convert their eligible silver to registered silver, if you like. But what the important point about the blue line at the bottom and the green line at the top, which is the registered and the eligible silver, both of them are trending downwards significantly. You can see that the amount of registered silver is half what it was back in October, not so long ago, just 6 months ago. It's halved. So silver is being drained from the CME warehouses because both the registered and the eligible silver numbers are dropping massively. The eligibles dropped by over 100 million, and the registered dropped by over 80 million. So both of those numbers are continuing to drop as people withdraw their silver. Now, what's interesting is the red line, which is going up, which shows us how much silver was demanded for delivery in May 2025, 1 year ago. So exactly a year ago, when the May contract matured, 75 million ounces were demanded for delivery. Now, not all of that would have left the CME because a lot of it would just change hands from owner A to owner B, and it would still stay in the CME. But what we don't know is who is behind, or who was and who will be behind the deliveries this time. Will they be people who just pass it from left hand to the right hand, owner A to owner B, and it stays where it is? Or are they commercial users of silver who are waiting for delivery, who will withdraw it from the CME? In which case, it's an unlikely scenario, but in that scenario, the silver isn't there. There isn't enough.
Yeah, so basically, I mean, there's a potential that all the silver, registered silver on COMEX could be gone.
One of the things which I always say is you have to listen to what the market is saying about itself. Now, the market we're looking at, which we should be looking at here, is the number of ounces at the CME warehouses, and you can look at LBMA as well. But that number is going down, 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 down every month. What that means is more silver is being consumed than can be brought out of the mines and put back into the CME. So the CME warehouses are slowly but surely being emptied because industrial users are using more silver than is coming in at the other end from the mines. So when you have a situation like that, you effectively have a supply shortage because you get to a point, and we don't know when we pass that point, but we will get to a point, if it carries on like this, where the silver just isn't there unless the price is bid up enough to encourage dishoarding.
I agree with Clive. You know, this supply deficit has been going on for 6 years, and they've been able to paper over it. But now countries want the real silver. And I think silver could do what tungsten, even though the tungsten market is quite a specialized market, but tungsten has gone almost outside China, unobtainium, and the price has gone up like tenfold. If you look back at the history of COMEX, the gold contract, for example, was created on January 1st, 1975. And there was like a Wikipedia document that was released. It was U.S. Treasury officials and State Department. They're talking to bullion dealers in London, and the whole idea behind the gold contract was to make it so that Americans wouldn't take delivery when they made gold legal again on January 1st. They wanted to create a very speculative and a paper market. But now it's all changing, Clive. Like your charts showed, there's so much delivery going on. And I think even if the price goes up, there isn't like that much silver being produced out there for the demands by the mines, and it takes a long time to get a mine up and running. So I think things are going to get very, very interesting for
The
silver.
bottom line is, if you take the period from October till today, the amount of silver, the registered silver has gone down by about 80 million ounces. We've only got 77 million left. So if that trend were to continue, and I'm not thinking it definitely will, but if it were to continue, it means in 6 months' time there won't be any silver there.
Silver will be 250 to 500 by the end of the year. Well, there are a lot of people that wouldn't be surprised. Michael Oliver, Bank of America, and Clive. Just wanted to ask you a question. If because silver is on the critical minerals list, gold isn't, but because the stock to flow in gold is huge, there's no shortage of gold. It's more of a monetary metal than silver, but if you think if the US is so concerned about the supply chain and minerals, do you think maybe they've had a word with the bullion banks to say, cool down on the manipulation or on the shorting of silver? Maybe they have because the open interest as well in the futures has gone down quite a bit, hasn't it?
Yeah, I mean, we can only speculate on this sort of thing. I think at the end of the day, there must be some sort of pressure going around to try and basically make sure that America, in particular, has enough supplies of all these critical minerals, and they'll be having quiet words with the various mining companies. They'll be having words with the bullion banks. They'll be having words with everybody in the chain to make sure that there isn't a supply disruption. So yes, I think it's likely, but they don't actually publish it on the front page of the newspaper.
No, and I don't know if you guys saw, but you probably heard of Andrew Maguire, both of you,
Yeah.
Clive. Yeah,
Yes.
yeah. I just saw that he posted something saying that J.P. Morgan is massively long silver now. I'm not sure how he knows that, but that's an interesting point as well.
In normal times, open interest is at the maximum around at the money option. So the open interest should be maximum for the 4,700, 4,750, $4,800 options. So it is kind of unusual to have much higher open interest at the far out of money options, as you're saying. That seems which what we have seen recently on three separate occasions, immediately prior to tweets by President Trump, that Polymarket had some very, very significant, huge, hundreds of $1 million bets in the right direction on oil. Well, I think there's oil and Bitcoin as well. There was a couple of things but there were some very, very large bets just before significant tweets which moved the markets in favor of the person who was making the bets. So one has to ask, are there people around, and I don't say it's the same people, but are there people around in the administration of the United States who know which way the wind is blowing and are putting their money where the whispers are?
So the way to calculate this, each option on COMEX is 100 contracts. So you need to calculate the open interest times 100 times the price. And I've come to there's a total of about $30 million worth of options here on these three strikes. And so, Clive, some people have said that people might be doing this because to trade volatility, but from I was telling MBA before you came on that I worked in the options market for many years, and traders, if they want to trade volatility, they'll buy the at the money call and at the money put, and they'll delta hedge. That's how they play volatility. This is more for an explosion in price. Wouldn't you agree?
Yeah, so someone out there is either taking a bet or perhaps they've heard a whisper that gold will be a lot higher. And maybe, the fact we've seen some large numbers of call options at the strike prices of 10,000, 15,000, and 20,000 kind of means they don't know where the number might end up. But they're putting a lot of money, because as you said, Mary, if you take the open interest multiplied by the strike price multiplied by 100, you get to some pretty large figures. They're putting a lot of money on something which in normal times would say is a very unlikely event. But black swans do happen. In fact, black swans are all too common. But the fact is they don't happen. They're unpredictable as to where they happen. That's why they're rare. So black swan event is when prices move far further than statistics say is possible. So, like as an example, when we had the October 1987 stock market crash, that was a black swan event. It was one of those events which is only supposed to happen once every 10,000 years.